Imagine owning a plush office unit in some of the most prime locals of India. Wait a minute, you think you cannot because you don't have the big mullah required to invest? Well, what if we told you that now you absolutely can? How? Watch this video till the end as we give you a lowdown of relatively new investment phenomenon in India known as real estate investment trust. So let's begin with what are real estate investment trust. Think of yourself like a kid standing outside a candy store. You obviously want to go in and buy all the candy, but you can't, right? So well, what if you were told that you can have a minimum of 10 candies at the store? In doing so, you will end up literally owning that much part of the store and keep getting more and more candy as the value of that store increases. Real estate investment work in exactly the same way. Most of us dream of buying properties across prime locals in India like BKC in Mumbai to earn great rental yields. However, in reality, neither do we have crores of rupees to invest in them, nor do we have the time, patience, and means to take on the hassle of maintaining it and ensuring regular rents from the tenants. REIT, or Real Estate Investment Trust, is basically an entity created with the sole purpose of channeling investible funds into operating, owning, or financing income-producing real estate. Think of mutual funds. Real estate investment trusts are modeled on the lines of mutual funds. However, in the case of REIT, they empower investors to get a stake in real estate and earn through rental yields and capital appreciation of the properties they park their money into with the help of experts. The best part? You don't need to have crores of rupees to invest. REIT can enlist themselves on stock exchange. So how investing in REIT differs from actually buying a property? Though they are based on real estate, REIT are nothing like traditional property ownership. A REIT is much like a specialized mutual fund that may invest in any of a wide variety of companies that build, own, and manage commercial real estate. So let us look at the brief history of REIT. Back in 1960, the very first REIT was ideated in the USA under the Cigar Excise Tax Extension Act. In 1965, REIT was listed on the New York Stock Exchange. In the years that followed, REIT started getting listed on the stock exchanges in several European countries, Japan, and Australia. REIT came to India 50 years later, but as they say, it's never too late. REIT entered India relatively later than most countries. Securities and Exchange Board of India, known as SEBI, introduced them in our country in year 2007. But anytime new, especially such a novel concept, was obviously going to take time to fork its way into the Indian real estate industry. Delays happened, oh yes they did. SEBI had drafted a few regulations, but they caused certain limitations and the idea never took flight. A few years passed. Then in 2013, SEBI revised its REIT regulations, which ultimately got green-lighted the next year on September 26, 2014. The most critical condition put by SEBI for obvious reasons was that unlike other countries where REIT consists of residential and commercial real estate, Indian REIT would exclusively for commercial real estate. Now let me introduce to you a very interesting concept. Suppose you invest in a REIT, but the tenants of that particular REIT vacate the property the next year. It is obviously going to be a bad investment idea, as you won't get your annual dividends. No tenants is equal to no returns. Enter WALE. What is WALE? It stands for Weighted Average Lease Expiry. It is a measure used to determine the chances of a property becoming empty. Experts believe that any REIT which has 5+ years showing as WALE make up for the safest investment in fruitful returns. So now you know what to do, right? Thumb rule numero uno: invest your money in a REIT which has 5+ WALE measure. So how does a company qualify as a REIT in India? In order to qualify as a REIT in India, SEBI has listed the following guidelines. It will constantly keep amending its guideline to enrich the REIT's experience further. The company has to have assets worth a minimum of rupees 500 crores. For an asset to qualify as special purpose vehicle, REIT will hold controlling interest and at least 50% of the total nominal value of equity in that SPV. So 80% of the investment must be made in income generating ready assets like commercial real estate, malls, etc. and only 20% of the total investment can be made in under construction assets. Reduction in trading lot size from rupees 1 lakh to rupees 50,000. SEBI might slash the minimal amount from rupees 50,000 to something lower for retail investors. Promoters owning 25% of voting rights allowed to increase their stake up to 10% against 5% previously. Recently, SEBI announced that the minimum investment has been reduced to 200 units from the previous 800 units. Now let us look at a few restrictions laid down by SEBI so that we have investors that can sleep peacefully at night. Indian REIT can invest in vacant land, agriculture land or mortgages or other than mortgages backed securities and foreign assets. It is mandatory for them to distribute a minimum of 90% of their taxable income annually in the form of interest dividend to their unit holders. What that means is if their taxable annual income is rupees 100, they will have to give out rupees 90 to the investors. So how can one invest in REITs? Individuals can invest in REITs in a variety of different ways, including purchasing shares of publicly traded REIT, stocks, mutual funds, and exchange-traded funds. It is important to check the occupancy level of the commercial real estate properties of the REIT before making any investment. So now let us get to the meat of the process, how exactly one actually can become a REIT investor in India. It is compulsory for REIT investor to have a demat account which should be linked to a bank account. Investors can choose the required IPO from the range of options available in net banking. Fill the form and mention the demat account number and code number. Choose the exchange, NSE or BSE. The price band is rupees 299 to 300 and you need to bid minimum of 800 units and it multiplies of 400 units thereafter. That means you need to invest at least rupees 2.4 lakh minimum in the trust. So the portfolio of investors, one should check and verify details of the promoter, the credentials of the developer, which companies have leased the property. So are REIT dividends taxable? Well, that depends on a certain conditions. If the SPV has opted to a tax at the concessional corporate tax rate of 22% against the general rates of 25 to 30%, the dividends declared by the SPV will be taxable in the hands of the unit holders and business trusts would be required to withhold tax at the rate of 10% when distributing income representing dividends received from SPVs. So however, just like the latest Mindspace REIT, which has surprisingly opted for 30% tax, so the dividends investors get would be exempt from any taxation. The objective seems to be extending one benefit, either exempt dividends or concessional corporate tax at SPV level. So investors in REITs also need to know that if they plan to sell the unit or units within just 3 years of investment, then they need to shell out 15% of tax payments. However, post 3 years of mark, the tax fee reduces to 10%. So now we will give you tips for a good REIT investment experience. So before investing in any particular REIT, investors should look for corporations who have a positive record when it comes to offering high dividend yields. It is also important to study the developer's role in providing capital appreciation. Other tips include investors can diversify the investment portfolio by purchasing shares through stock exchanges without the need to stay invested for that long term. Investors should park into REITs that hold diverse properties and tenants. They should opt for ETFs and mutual funds options that invest in REITs. Since these funds come with professional assistance, investors should be able to manage them more proficiently. Opting for companies that have been active in the field for several years and have an experienced core team would prove more beneficial. So now we will lay out some advantages and disadvantages of REITs. Just like any other investment tool, REITs too come with a host of pros and cons. Advantages of REITs. REIT is regulated by SEBI, and that is why it has the following advantages. Investors will be able to gain exposure to real estate with small amounts of as less as rupees 2 lakh. Opens a wider investment basket for investors beyond debt, equity, commodities, and money market. Since REITs primarily are for projects which are already built, it is definitely a safe investment. Nothing is hidden from investors and everything is laid out in a very transparent manner. The disadvantage of REITs. One thing to remember is that, like equities, real estate markets will never always be in a good phase. Unlike mutual funds where one can invest a few hundred rupees, REITs call for a minimum rupees 50,000 for a 3-year lock-in period. Due to the large ticket size, even in times where the market is doing well, investors may find it difficult to sell and exit. So let's compare REIT with direct property buying. With the direct real estate investment, you buy a specific property or stake in one, such as apartment complex, residential, or a shopping center commercial. Direct real estate investors make money through rental income, appreciation, and profits generated from any business activities that depend on that real estate. REIT makes sense for investors who don't want to operate and manage real estate, as well as for those who don't have the money or can't get the financing to buy a real estate. So REITs are also a good way for beginner real estate investors to gain some experience with the industry. So let's now compare REITs with real estate company shares. So there's a slight difference between REIT and real estate company shares. When one buys a real estate company shares, how it works is that company's planning is decided by its management and it is free to choose wherever it invests. It can buy residential, commercial, or retail properties or invest in a piece of land and not do any work on it for an extended period of time. In short, the rise and fall of the value of the shares you have bought will be directly dependent on how the company operates. When a company earns a profit, it is obvious that it will reinvest its return back to the market, and then if it incurs a loss, the shareholder will end up losing the money invested. This will cause an execution risk for the investor. But on the other hand, REITs come packed with many regulations by SEBI as listed above. So here you will get a rental dividend twice a year. This ensures that your investment is parked much safely. Now let's compare REITs with fixed deposit. In comparison to fixed deposit, you get good returns on REITs. Also, fixed deposits have longer waiting periods than REITs for dividends. It can take a minimum of 3 to 10 years for a fixed deposit to get the desired returns to an investor. So how much rental yield and capital appreciation can be expected in REITs? Now this is the part every one of you is waiting for. How much can you expect to earn if you become a REIT investor? According to the industry estimates, the rental yield for a commercial property is in the range of 7 to 9%, while the capital appreciation can be expected to be between 5 to 7% over a long term. So according to industry reports, from its establishment in April 2019 to June 2020, Embassy REIT has outperformed the BSE Realty Index and has given 14% returns. So what is the market arbitrage impact on REITs? In times where there is uncertainty hovering in the commercial real estate market, as was experienced when COVID-19 pandemic hit us, followed by a lockdown, if one buyer units at such a time, it results in an arbitrage opportunity. A unit costing rupees 500 might reduce its price to 300 and one can buy it at a price much lower than its original value. To enjoy this, one must have a seasoned understanding of real estate dynamics. As you all by now know, India so far has two REITs, Mindspace Business Park REIT and Embassy REIT. They both have a few differences. Let us break them down for you. Mindspace Business Park REIT launched its 3-day initial public offering on July 27 to raise up to 4,500 crores as it looks to part debt and monetize its assets. The IPO is backed by Blackstone Group and K. Raheja. In April 2019, Embassy Office Parks, also backed by Blackstone, had raised nearly rupees 4,750 crores. So now let us take a look at their key differences. So let's talk about the difference between Embassy REITs and Mindspace Business Park REIT. Embassy assets locations are Bengaluru, Mumbai, Pune and Noida. Mindspace assets locations are Mumbai, Pune, Hyderabad and Chennai. Embassy also has 1096 hotel keys and 100 megawatt solar park. It has more assets than Mindspace. In Mindspace, rent is 22% financial sector and 45% in technology sector, which is lesser than Embassy. In Embassy, the integrated business parks are 7 and independent offices are 4 and tenant bases are 160 plus and total leasable area is 33.3 million square feet. Ready assets is 26.2 million square feet and under construction is 3.9 million square feet. Future assets is 4.5 million square feet. Revenue from Fortune 500 companies are 43.4%. Revenue from top 10 tenants are 42%. Committed occupancy is 92.8%. Rent per square foot is rupees 68. WALE is 7 years. Right issue price is rupees 362 and it offers a much lower discount to investors. In Mindspace, integrated business park is 5, independent offices are 5, tenant base is 172, total leasable area is 29.5 million square feet, ready asset is 23 million square feet, under construction is 2.8 million square feet, future asset is 3.6 million square feet. Revenue from Fortune 500 companies is 39.4%. Revenue from top 10 tenants is 41.6%. Committed occupancy is 92.4%. Rent per square foot is rupees 52 and the WALE is 5.8 years. Right issue price is rupees 275 and it offers a higher discount to investors. I hope these key differences between Embassy REIT and Mindspace REIT will give you an opportunity to know where to invest in. So, global investment firm Brookfield has proposed to launch a REIT public issue for raising over rupees 4,000 crores. RMZ Group, Godrej Properties and Panchsheel Realty are also some of the major Indian real estate players who are keen to list REITs soon. India has approximately 650 million square feet of grade A office space and 310 to 320 million square feet out of that can be easily be listed as REITs. India's office stock is estimated to reach 1 billion square feet in the next 6 to 8 years. By 2022, experts estimate that close to 100 million square feet will be listed as REITs. So it is safe to assume that REITs are here to stay and investors are going to benefit heavily from them. For more updates, trends and insights by RealtyNXT, do not forget to share, like and subscribe RealtyNXT.